Hi everyone, I'm Natasha, the CEO and co-founder of Cable, and I'm joined today by Jamie Sloan, the Executive Director at the Innovation Lab at Main Street Bank. Thank you so much for joining me, Jamie.
Fabulous to be here. Thanks for the invite, Natasha.
Today we're going to talk about the regulators in the US. It is a complex topic. There are lots of different regulatory bodies, and it is a pretty unique setup. So to get us started, Jamie, can you just give us an overview of all of the different regulatory bodies, who they are and what they do?
I can certainly give it a good try. And I think I'm going to structure it from a when they were created framework. So we've got a structure of supervisory bodies relating to just simply how the banking system has evolved and directly tied, quite frankly, to a number of different financial crises. So we had the way banks started in the United States, they started out at the state level and there were individual banks and they were minting their own currency and had their own state rules. And President Lincoln said, hey, wait a minute, we need a more stable federal system with a uniform set of rules. And what came about from that is the National Bank Act in 1863 that created the first federal banking agency, the OCC. They supervised national banks. One set of rules can be located nationwide. Then
So
along
before,
came,
so before that, each state had their own currency.
they did, well, no, banks in each state. So it wasn't even a
Oh
state-based currency.
wow,
It was the banks had their own currencies.
that's wild. That must have been
Right, right.
been
I think,
complicated. Yeah.
yeah, well, similar to like, I think in some ways banks in the UK can create, mint currency as well. So
Oh wow.
that's the way it was working in the United States at the state level. So imagine the uncertainty that arises when a bank is in troubled condition and they have their own currency and suddenly they've got no capital and their assets are worth nothing, and where do you go, right?
Mhm.
So um, there was a particularly severe panic back in the early 1900s that resulted in bank runs. So now we already have national banks, but another banking crisis ensues. And what this brings about was Congress creating the Federal Reserve Act, and this created the Federal Reserve. So the Federal Reserve, they supervise holding companies. They're responsible for the money supply. We hear all about the Fed and managing interest rates. So they are both concerned about the safety and soundness of the nation's financial institutions. They're also concerned and have the lever. They pull the levers on the economy.
Mm.
Then we've got the FDIC that came about in 1933. Yet another banking crisis. Imagine, do we see a pattern surfacing here? And the FDIC is, by its very design, focused on the stability of the financial system by ensuring deposits. And they also supervise a certain set of financial institutions, those at the state level that aren't members of the Fed. We can get into the complication of that, but ultimately, national banks are members of the Fed. They have to be by law. Not every state bank needs to be a member of the Fed. And so you've got state regulators and FDIC regulators in that space. But honestly, the FDIC serves as a backup regulator for all the banks. Because when a bank fails, the FDIC, they kick into action. Right? They got a whole team to handle resolution. So that's the FDIC. And then we're at the CFPB, right? The kind of bringing up the rear in terms of federal regulators, notwithstanding the National Credit Union Association, but that the CFPB, the Consumer Federal Protection Bureau, was created in 2011. This came out of Dodd-Frank, yet another financial crisis. And the CFPB, its primary role is to supervise financial institutions in the consumer space, right? They are there and they write the rules. They're responsible for the promulgated rules for consumer protection, and they see to it and supervise the nation's some of the largest institutions, those 10 billion and above, as it relates to adherence to consumer protection and appropriate compliance management systems.
That is fascinating. Thank you for the history lesson. It is very complex. Why don't we dive into each of these one by one? So why don't we start with the OCC? Tell us, as the national regulators, what do they do and why are they different and unique?
So the OCC really has one job, right? To supervise the national banks. They charter those national banks. So when you want to charter a financial institution, that's OCC national charter. There's application process. They review those applications in connection with the FDIC has its own responsibilities around all charter approval, but the OCC charters those financial institutions, and therefore anything that's an OCC regulated bank follows the rules that the OCC then promulgates, and it's one set of rules. Whereas if you were chartered in a state by that state authority, you follow the rules of that state. So simple, unified, well, nothing simple in the regulatory space. I strike that from the record. But a uniform, consistent set of rules for national banks, no matter where they operate from.
And can any bank decide to try to become OCC regulated?
There's application process, of course, and there are
Yeah.
certain obligations that you must meet in order to successfully address all the expected requirements of an OCC national charter. So certainly you can apply. I mean, we see a lot of our friends out there in the LinkedIn world tracking what's happening in this chartering space because it hasn't been a very prolific engine of late. So,
Are there any restrictions on things like the number of states you're in, or the number of people you're servicing, or the amount of capital you hold to become an OCC regulated bank versus one of the other supervisory bodies?
there may be different capital
Mhm.
levels, right? Really risk dependent. There aren't typically state restrictions, like you can only operate in one state. When you charter a de novo institution, you come to the OCC with a plan that
Mhm.
says, this is going to be our business, this is going to be our target client set, this is how we intend to operate, here's all our policies and procedures, this is going to be our IT core, this is the amount of capital we're going to have, here's who's going to own us, here's going to be the management team. All those things are subject to OCC review and approval. And then when the OCC blesses you and says, go, run, you've got a de novo charter, now you've got to follow that business plan. And the OCC may issue requirements around your with an operating agreement that says, thou shalt do these three, these things pursuant to what we've agreed to with your charter. So
Mhm.
it isn't just like, okay, we got a charter, we can run amok.
Yeah.
Woo-hoo, we're a bank now, right? It's done so in a chartering is done so in a very measured way with agreed upon plan and pursuit. And the OCC tracks this very closely
Mhm.
in terms of, and the supervisory hand is much closer to a de novo institution, seeing to it that it follows that plan, and deviations from that plan get very tough scrutiny.
Yeah. Fascinating. And so, what about the FDIC? Where do they, if they are insuring all of those banks that are FDIC regulated, where do they come into play? How do they relate to the OCC?
So in this sort of chartering world, as I understand it, right, you're submitting a charter to the authority that you want uh, to charter your institution, and there's also simultaneous with that application to the FDIC, because the FDIC also has to approve these plans. They have their own approval process to determine whether or not you're insurable. So they've got their own marching orders and protocols to address their minimum standards for chartering and granting of FDIC insurance. So they
And
are.
so,
Oh, so as it relates to like the OCC and the FDIC, when it comes to supervision, the OCC we call the prudential regulator. They are the primary regulator of national banks. The FDIC is there in the background. They have access to supervisory information should they need it, and often, in problem situations, the FDIC becomes a more prominent player in the mix. But and when you walk in the door and you shutter a financial institution because they've failed, the FDIC is on site with you.
And so is it possible for a bank to become OCC regulated without the FDIC insurance, or does the FDIC insurance have to happen and then you can become OCC regulated?
Okay, now you're testing me. I think an OCC trust charter doesn't involve FDIC insurance.
Okay, what is an OCC trust charter?
So banks can have trust powers. National banks can have trust powers. Other banks can have trust powers too, but under 12 CFR 9, the trust the regulation that outlines how you conduct trust activity, the legal requirements around a trust charter, FDIC insurance is not required.
Doesn't sound like that was much of a test, given you were able to spew the
Well, like
relevant.
there's a whole complex.
Need to
That's why I
find some
don't
harder
mean to
questions.
oversimplify. My friends at Anchorage would go, Jamie, like trust charters are not, they're not easy charters to land. Doesn't just because they don't have FDIC insurance doesn't mean it's an easy charter to land at all
Of course.
or to
Okay.
operate.
So
It has its own set of complexities.
yeah, absolutely. And so the OCC, the primary national regulator, one set of rules, of course, very complex because it's compliance and regulation. And they work very closely with the FDIC, who provides the insurance for those banks, and the FDIC does have access to that supervisory information as well. So where does the Fed come in? You said earlier that not all banks are regulated by the Fed. Who would be? Why would that happen?
So the Fed is responsible for granting bank holding companies. So the Fed supervises a bank holding company. So often we find a financial institution decides that it wants to have a bank holding company because it might want to have certain capital structure flexibilities or own assets that can't be owned by a bank per se, not permissible banking. So the Fed grants the holding company, and when you create a holding company, welcome to Fed supervision. So you've got that. And the Fed supervises member banks, so you don't necessarily have to have a holding company to be supervised by the Fed if you're a financial institution, if you're a member of the Federal Reserve System. State banks don't have to be a member of the Federal Reserve. They can be chartered at that state level and not a member of the Federal Reserve, so their access to the payment systems is through a correspondent bank, not directly with the Fed.
So if a bank is directly connected to the payment systems and is therefore a member of the Federal Reserve, they are automatically regulated by the Fed.
Member Fed, they have. So the Fed doesn't regulate OCC banks, but OCC banks have to be a member of the Fed.
OCC banks do have to be a member of the Fed. Okay.
That by law, yes.
Okay.
Fed member banks that are state chartered financial institutions, the Fed is their primary regulator.
Oh, fascinating. Okay, so if you are OCC regulated, then you have to be a member of the Fed, and the Fed regulate you kind of alongside coordinating with the OCC. And if you are a state regulated bank, then if you're a state regulated bank and if you choose to be a member of the Fed, then the Fed is your main regulator.
That's right. And one distinction around that OCC Fed relationship, the OCC is the prudential regulator of national banks. I examined a bunch of national banks. Fed's nowhere around. They're not, they're not part of that supervisory process until you get to the really big banks. Then the Fed's on site, where the OCC's on site, the Fed's on site, the FDIC's on site. So they're all there. But you just take your typical community bank, and you're an OCC regulated community bank. You're only going to see the OCC examiners. Coming on site, conducting exams. So you wouldn't be thinking specifically about Fed examiners. The OCC is your prudential regulator.
Got it. Okay. That's very
It's
interesting.
complicated, Natasha.
It
You
is.
know, clearly, like you're asking the question, so it's we need a we need a Venn diagram
We
of
do.
and it's a patchwork quilt, and you can see, you know, it's been built. History has impacted where we are today. There have been some regulators who've been taken out of the mix.
Oh, yeah.
OTS doesn't exist anymore, right? The
Hmm.
OTS was responsible for thrift charters, chartering those thrifts. They were the thrift parallel regulator to the OCC. Now the OCC, with Dodd-Frank, is responsible for all national, federally chartered institutions, be they national banks and thrifts. So it's not, it could be more complex. Some have been removed from this
Wow. And
consolidations.
so, and so, how on earth does the CFPB play into all of this? Where do they come in? When do they get involved? Who is regulated by the CFPB?
Okay, so the CFPB, they're responsible for compliance risk management practices at banks 10 billion and above. So a community bank under 10 billion likely not thinking about the CFPB walking in their front door to regulate them. However, the CFPB promulgates the rules, the consumer protection rules that banks follow. So, Regulation B, for example, fair lending, um, right, Equal Credit Opportunity Act. The CFPB is responsible for Equal Credit Opportunity Act, writing that rule, making revisions to that rule. And so we care about what the CFPB is doing, no matter the size of your institution, because how they're enforcing and thinking about um, what they expect with respect to financial institutions. We're all watching what the CFPB does because it has impact across the industry. So the
And so,
CFPB, oh, go ahead.
sorry, I was going to ask there. So, if you were running a small community bank that was less than $10 billion in assets, do you still have to follow the CFPB regulations, even if they don't come and regulate you?
They don't regulate, they don't examine you,
They don't
but you
examine
follow,
you.
you are still required to adhere to the rules. That's correct. So so we're going to stick with the OCC,
Yeah.
my former home. Community bank, national bank, OCC supervised. Um, the OCC is responsible for the examination of that institution for safety and soundness and for compliance with applicable law, rule, and regulation, including consumer protection. So, a
Mhm.
community bank sitting in Rockford, Illinois, you know, where I went to high school, a community bank sitting in that community in that town gets examined by local examiners that are in Northern Illinois. It's where I cut my teeth as a bank examiner. You examine that bank for its safety and soundness, the capital adequacy, asset quality, management, earnings performance, liquidity, and its adherence to compliance rules and its compliance management system and its IT practices. You grade
Mhm.
IT, and if it's got trust powers, you examine it for trust powers. So the examiners, like that community bank examiner, they do everything. They examine everything. So at that community bank, when the specialization comes in, when you're a financial institution over 10 billion, the CFPB has authority to come in and examine you themselves. Your prudential regulator, like the OCC, may be doing some examination across, looking at your compliance management system, how you're operating that, because the compliance management system isn't strictly consumer compliance
Mhm.
focused. So, looking at how you execute that risk management program, the CFPB comes in following their own strategies, adhering, fulfilling their own strategic plan as they examine financial institutions for adherence to consumer protection, consumer fairness, um, everything under their mandate.
Got it. That's fascinating. It is highly complex, and anybody entering this space, I guess, has a lot of decisions to make as to whether they intend to just work in a state or whether to be nationally chartered. And with the move to banking almost entirely being online for a lot of people, that I imagine means that we might see a trend more towards OCC chartered banks, because if somebody not in a state downloads an app and wants to access a financial institution, they may not know where that bank is. And if the bank is servicing consumers in different states, they will have to be either OCC regulated or complying with all of those different state laws.
Bingo. Right. Yeah. So I think you do end up, I think this is an interesting conundrum to talk about. It's like each state has, much like the federal regulators, they regulate the financial institutions in that state. They're concerned about the safety and soundness of of those institutions, the consumer protection of their uh, citizenry. So they've got their own rules. Like Illinois, where I'm located, has a very impactful law around biometrics and biometric policy. So if you're a financial institution that has customers in Illinois, consumers in Illinois, and you use biometrics as part of your on account opening and authentication process, there are all these disclosures that you have to have around biometrics. Thank you, Illinois. California is another one, right? We hear about California privacy, and if you're operating in and serving the needs of consumers in California, doesn't mean a bank in Virginia, like the one I work for, can't have customers in California. You simply have to think about what are the particular California rules that impact the business of banking that we're doing in that state, and you've got to adhere to those rules.
And if you are a state chartered bank, what opens you up to having to comply with another state's regulatory requirements? Is it simply one individual customer wanting to use your banking services, or is it about you marketing your services in a state?
You know what? You are now creeping into legal advice,
Mm-hmm.
which I don't. I'm going to be very careful and stay in my lane. I do think I'm going to, take the conversation up a level.
Sure.
So, why would you charter? What's your business strategy? And that helps you define kind of what sort of charter you think best suits
Mm-hmm.
your
Mm-hmm.
business model, right? You want to align the charter with the business model for what makes sense and is the most efficient and effective for you to prosecute that business. So if you're chartered in a state, and you start to move outside of your geography, you've probably
Mm-hmm.
heard of the Community Reinvestment Act, right?
Mm-hmm.
Which is a rule that says you got to really invest in the communities where you take your deposits from. You got to invest, you have to lend, you have to support your customer base in that community that's been, traditionally been very much defined by where are your brick and mortar locations, and that draw a line, draw a circle, a radius around that branch, your headquarters, and this becomes your CRA geography for purposes of evaluating your adherence to that particular rule, which every bank is subject to.
Mm-hmm.
So when you start to expand your strategy, now you start to think more and more about business outside of that. Like if you're going with an online strategy, it does have impact on how you're going to be thinking about your satisfaction of the CRA,
Mm-hmm.
the Community Reinvestment Act, its rules, and the measurements that you use to judge that performance. So I think it does come into play. Banks aren't prohibited. A bank in Virginia isn't prohibited from doing business in Virginia. It makes the regulatory patchwork quilt a little more complex.
Yeah, fascinating. Thank you so much for giving us a history lesson on the US regulators. It's complex and interesting, and it sounds like we'll have a new regulatory body if there is when there is another financial crisis.
Not necessarily, but it's it's valuable to reflect on why we are where we are, and
Mm,
what we have incurred in our economic history, and how policy gets made and impacts the way we're operating today. It's certainly important to pay attention to history. One, certainly don't want to repeat failures of the past, and to inform where we need to go in the future.
yeah. Thank you, Jamie. Really
You're
appreciate it.
welcome. Yeah, my pleasure, Natasha.